Trading in financial markets can be exciting and potentially profitable. However, it is crucial to approach it with a well-defined strategy to increase your chances of success. Without a clear plan, traders often fall prey to emotional trading, leading to inconsistent results and potential losses. A well-structured trading strategy should encompass market analysis, entry and exit points, risk management, and position sizing. By adhering to predefined rules, traders can bring discipline and consistency to their trading activities. One such strategy is the till channel change strategy, which involves identifying market channels and capitalizing on price movements. Whether you are new to trading or have some experience, adopting a structured approach like this can improve your trading outcomes. The till channel change strategy is a trend-following approach that focuses on trading within established market channels. A market channel represents the price range within which an asset trades, characterized by parallel trend lines that act as support and resistance levels. The strategy involves identifying an existing channel by drawing trend lines connecting recent highs and lows. Traders look for potential entry points within the channel, aiming to capitalize on price movements towards the upper or lower trend line. The core idea is to hold the trade until the price breaks out of the established channel, signaling a potential trend reversal or continuation. One critical element is the use of the average true range (ATR) to determine profit targets based on market volatility. The strategy can be applied to various financial instruments, including stocks, currencies, and commodities. Thorough backtesting and understanding the strategy's limitations are crucial before implementing it in live trading. Identifying market channels is the foundation of the till channel change strategy. To identify an uptrend channel, connect the recent significant lows with an upward sloping trend line. For a downtrend channel, connect the recent significant highs with a downward sloping trend line. The trend lines act as dynamic support and resistance levels, and the price is expected to move within these boundaries until a breakout occurs. In an uptrend channel, traders look for buying opportunities near the lower trend line, with a profit target near the upper trend line. In a downtrend channel, traders look for selling opportunities near the upper trend line, with a profit target near the lower trend line. Traders can use technical indicators or candlestick patterns to determine entry points. For example, a bullish candlestick pattern near the lower trend line in an uptrend channel could present a buying opportunity. As long as the price respects the overall trend and the trend lines hold, the strategy remains valid. Managing risk is crucial for any trading strategy, including the till channel change strategy. One primary risk management technique is setting a stop-loss order outside the identified channel. Position sizing is also essential, determining the amount of capital allocated to a trade based on risk tolerance and market volatility. The strategy may require adjustments based on changing market conditions. In volatile markets, traders may widen the channel width or adjust profit targets and stop-loss levels. In less volatile markets, traders may tighten the channel width or adjust profit targets and stop-loss levels accordingly. Be aware of false breakouts where the price briefly breaks out of the channel but quickly reverses. To mitigate false breakouts, use confirmation indicators or candlestick patterns to validate the breakout before entering a trade. Adjust entry points slightly outside the channel to avoid being caught in false breakouts. The till channel change trading strategy offers several benefits for traders. Simplicity. It is relatively easy to understand and implement, even for beginners. Objectivity. It relies on clear price action and trend lines, reducing subjectivity in trading decisions. Trend following. It allows traders to capitalize on established trends, potentially leading to larger profits. Clear profit targets. The use of ATR helps determine realistic profit targets based on market volatility. However, the strategy is susceptible to false breakouts and may not perform well in choppy or sideways markets. Identifying channels accurately can be subjective and may vary between traders. To mitigate these drawbacks, combine the strategy with other technical indicators, price action patterns, and risk management techniques.